Welcome to our video on capital investment decisions. In this video, we will explore the fundamentals of capital investment and its significance in business. But first, what exactly is capital investment? Simply put, it's the funds invested in a business to further its objectives, such as purchasing machinery, buildings, or technology. Understanding capital investment is crucial because it plays a pivotal role in a company's growth and long-term success. From boosting productivity to fostering innovation, these investments are the backbone of any thriving enterprise. So, whether you're a budding entrepreneur or a business student eager to learn, mastering this concept is essential. Stay tuned as we dive deeper into the world of capital investments, their types, and how they can propel your business to new heights. Next, you'll discover different facets of capital investment, including real-world examples and methods to evaluate investment projects. Let's get started on this educational journey into the heart of business finance. Welcome to our deep dive into capital investment decisions. In this segment, we start with a fundamental question. What is capital investment? Capital investment refers to funds put into a firm or enterprise with the goal of furthering its business objectives. These investments can take various forms, such as purchasing machinery, acquiring buildings, or investing in advanced technology. Each of these examples demonstrates how capital investment is not just a financial term, but a strategic decision impacting a company's future growth and efficiency. Understanding capital investment and recognizing its different forms provides the foundation needed to delve deeper into how businesses make well-informed investment decisions. As we move forward, you'll see why these investments are vital for growth and how they help maintain a competitive edge. Now, let's examine the importance of capital investment for any business. Capital investments are pivotal for achieving growth and expansion. They enable companies to scale operations, meet increasing demand, and explore new markets effectively. Moreover, investing in advanced machinery, new technologies, and infrastructure boosts efficiency and drives productivity. This is essential for staying competitive in today's dynamic business environment. By strategically deploying capital, businesses can gain a significant edge over competitors, ensuring they remain at the forefront of their industry. As we proceed, you'll understand how these investments can transform business operations, providing both immediate benefits and long-term advantages. Let's dive deeper into the different types of capital investment decisions next. In the realm of capital investment decisions, it's essential to recognize the different types that businesses frequently encounter. First, we have expansion decisions. These involve investments aimed at increasing a company's capacity, entering new markets, or launching further initiatives to boost growth. Next are replacement decisions, made when it's time to renew or replace outdated or inefficient equipment and facilities. Investing in replacements can improve operational efficiency and reduce long-term costs. Finally, we have new product decisions, which involve allocating capital towards the research, development, and launch of new products, opening new revenue streams, and keeping the company competitive. Understanding these types helps in making informed and strategic capital investment choices. Up next, you'll see how various factors influence these decisions and methods to evaluate potential projects effectively. In the realm of capital investment decisions, several key factors come into play. First and foremost is market conditions. Businesses must analyze economic trends, consumer behavior, and competitive landscapes. Then there's the financial health of the company. Robust financial statements and forecasts bolster confidence in making significant investments. Lastly, technological advancements are crucial. Keeping pace with innovation is not just an option, but a necessity to maintain a competitive edge. These elements interact to shape the landscape of capital investment decisions. Up next, you'll discover how to evaluate investment opportunities using different financial metrics, ensuring you make informed and strategic decisions that drive growth and success. To make well-informed capital investment decisions, businesses employ various evaluation methods. One key method is net present value, or NPV, which allows companies to determine the present value of future cash flows, adjusting for the initial investment costs. Another essential method is the internal rate of return, or IRR, which helps businesses identify the discount rate that results in a net present value of zero. Finally, the payback period measures how long it takes for an investment to recover its initial costs, providing a clear timeline for financial returns. By understanding and applying NPV, IRR, and the payback period, firms can comprehensively assess the potential profitability and risk of their capital investment projects. These tools are crucial in helping prioritize investments that align with their long-term goals and financial health. Up next, let's take an in-depth look at NPV and its role in evaluating investment opportunities. Net present value, or NPV, is a crucial concept in evaluating the profitability of an investment. It involves calculating the present value of future cash flows and subtracting the initial investment cost. To calculate NPV, future cash flows are forecasted and then discounted back to their present value using a specific discount rate. This present value is compared to the initial outlay. If the NPV is positive, the investment is likely to be profitable. If negative, it may result in a loss. One of the main advantages of using NPV is its ability to account for the time value of money, ensuring future cash flows are accurately weighted against the initial investment. Moreover, NPV provides a straightforward metric for comparing multiple investment opportunities, aiding businesses in making sound financial decisions. Next, you'll explore the internal rate of return and how it complements NPV in capital investment analysis. In this segment, we'll delve into the concept of the internal rate of return, or IRR. The internal rate of return is the discount rate that makes the net present value, or NPV, of all cash flows from a particular project equal to zero. Calculating IRR can be intricate, as it requires finding the discount rate that sets the NPV to zero, usually through several iterations and the use of financial calculators or software. One of the key advantages of IRR is its simplicity in comparing different projects. By providing a single percentage, it allows businesses to easily determine which investments promise the highest returns. Additionally, IRR takes into account the time value of money, offering a more accurate measure of an investment's profitability. Next, you'll learn more about how to apply IRR effectively and its role within financial evaluation methods. The payback period is a crucial metric in capital investment decisions. It represents the amount of time it takes for an investment to generate enough cash flow to cover its initial cost. Calculating the payback period involves summing up the net cash flows from the investment and determining when they equal the original outlay. Among its advantages, the payback period helps in assessing the liquidity of a project and can be particularly useful in comparing projects with similar risks. However, it's essential to remember that this metric doesn't account for the time value of money or cash flows beyond the payback period. Up next, you'll see how the payback period fits into the broader context of evaluating capital investments. Let's address some common questions about NPV. What is NPV? Net present value measures the profitability of an investment by comparing the present value of future cash flows to the initial investment. How is NPV calculated? To calculate NPV, you discount future cash flows to their present value using a specific discount rate, then subtract the initial investment. This gives you a figure that represents the expected financial gain or loss from the investment. Why is NPV important? NPV is crucial because it helps businesses determine the potential profitability of an investment, allowing for better informed decision-making. A positive NPV suggests the investment is likely to generate more value than its cost, while a negative NPV indicates the opposite. Up next, you'll see how this method compares to other evaluation tools like IRR. Let's address some common questions about IRR, or internal rate of return. First, what exactly is IRR? In simple terms, IRR is the discount rate that makes the net present value of all cash flows from a particular project equal to zero. How is IRR calculated? This involves using financial formulas or software to find that exact rate where the NPV equals zero, which can indicate the project's potential profitability. But why is IRR important? Understanding IRR helps businesses evaluate and compare the feasibility of different investment opportunities, ensuring that they pursue the most financially beneficial projects. Next, you'll discover how mastering IRR can significantly impact your capital investment decisions. Let's address some common questions about the payback period. First, What is the payback period? The payback period is the amount of time it takes for an investment to generate an amount of money equal to its initial cost. How is the payback period calculated? You simply divide the initial investment by the annual cash inflows generated from the investment. For example, if a project costs $10,000 and generates $20,500 each year, the payback period would be 4 years. Why is the payback period important? It helps businesses evaluate the risk of an investment and decide whether they can recover their outlay in a reasonable time frame. Though it doesn't account for the time value of money, it provides a straightforward way to assess the liquidity and risk of an investment. Next, we'll dive into a real-world case study to see these concepts in action. In this segment, we delve into a fascinating case study of a successful capital investment. To fully grasp the elements of this triumph, we'll break it down into 3 main parts: the company's background, the pivotal investment decision, and the remarkable outcome produced. First, let's introduce the company at the heart of our study. This firm, known for its innovative approaches and steady growth, found itself at a crossroads. With a solid market presence in the technology sector, they had established a reputation for quality and reliability. Yet, they sought to leap even further ahead. Here came the critical moment of their capital investment decision. After thorough analysis and consideration, the management resolved to invest significantly in advanced manufacturing equipment. This decision wasn't made lightly. It was rooted in a strategic vision to upscale production capabilities, enhance efficiency, and reduce operational costs. The investment aimed to modernize their existing manufacturing process. By incorporating cutting-edge technologies, the company anticipated this move would yield substantial cost savings and open new markets. The decision-making process involved rigorous financial evaluations, considering factors such as net present value, NPV, and internal rate of return, IRR, to ensure the investment's viability and profitability. After a period of calculated risk-taking and careful execution, the outcomes began to surface. The modernized equipment transformed their production line, resulting in a significant boost in output and quality. Not only did efficiency soar, but the firm's reputation for innovation was strengthened, attracting new clients and partnerships. Financially, the investment proved lucrative. The cost savings generated by the enhanced efficiency quickly offset the initial expenditure, providing a substantial return on investment. In a short span, the company saw its market share expand and its stock prices surged, reflecting the positive reception from investors and stakeholders alike. This case encapsulates the core principles of making informed capital investment decisions. By understanding the company's background, carefully planning the investment, and executing it with precision, this firm achieved growth and success beyond initial projections. As we move forward, you'll see more examples and discussions that build on these fundamentals, highlighting both the challenges and strategic solutions in capital investment. Capital investment decisions are never without their challenges. The landscape is fraught with uncertainty, where future market conditions and technological advancements are often unpredictable. This uncertainty makes it crucial to perform thorough risk assessments. Understanding potential pitfalls could mean the difference between success and failure. Financial constraints present another significant hurdle. Companies must balance their ambitions with budgetary realities, often forcing difficult choices between various projects. These challenges are omnipresent, demanding a meticulous and strategic approach from decision-makers. As we move forward, you'll see the strategies businesses employ to mitigate these risks and navigate these challenges effectively. In the realm of capital investment, mitigating risks is paramount for safeguarding financial health. Businesses can adopt several strategies to shield their investments from potential pitfalls. First and foremost, diversification is key. By spreading investments across various assets or sectors, a company can cushion the impact of any one investment going awry. Thorough analysis is another crucial step. This involves meticulous research and evaluation of potential investments to understand their viability and forecast their performance. By grounding decisions in solid data and predictive models, businesses can navigate uncertainties more effectively. Lastly, having contingency plans in place is essential. These plans act as a safety net, providing alternative courses of action should the primary investment strategy falter. By anticipating possible challenges and preparing for them, companies can ensure they remain resilient in the face of unexpected events. Next, you'll see how to implement these strategies effectively and their real world impact on reducing investment risk. Let's take a moment to summarize the key concepts we've covered in this video. We started by delving into the basics of capital investment, establishing its significance in business finance. Then we explored methods for evaluating investments, such as net present value (NPV), internal rate of return (IRR), and the payback period, each vital for ensuring informed decision making. Throughout the video, we addressed common questions about these evaluation methods, providing clarity and deeper understanding. Remember these foundational principles: comprehending capital investment, applying evaluation methods, and knowing the answers to essential questions are critical for success in capital investment decisions. Stay tuned as we move into final thoughts and ways to implement this knowledge effectively. As we wrap up our exploration of capital investment decisions, it's crucial to underscore the importance of making informed choices for business success. Every decision you make shapes the future trajectory of your enterprise. Stay curious and committed to continuous learning. By keeping abreast of the latest trends and methodologies in capital investment, you secure a competitive edge. Remember, knowledge is power, and in the dynamic world of business, staying informed is vital. As you embark on your journey, let the insights and strategies garnered from this video guide you. The path to successful capital investment is paved with the principles we've discussed today. Throughout your career, make it a point to deepen your understanding and refine your skills. This commitment to growth and knowledge will be the cornerstone of your professional success. Informed decisions are key to unlocking new opportunities and achieving long-term business growth. Thank you for joining us on this educational journey. Thank you for joining us on this journey through the intricacies of capital investment decisions. If you found this video helpful, please subscribe to our channel for more insightful content. Don't forget to like this video and share it with your colleagues and friends who might also benefit. We value your feedback and questions, so leave a comment below with your thoughts or any queries you have. Your engagement helps us to create more relevant and useful content for you. Stay tuned for our next video, and together, let's continue exploring the world of business finance. Thank you for watching, and see you next time.